Good afternoon, everyone. Deacon Steve Stemper here with the Catholic Foundation. So glad you're able to join us for this next round of our planning and giving webinar series. We're going to get through this in about 45 minutes. And if you have any questions, we encourage you to send those to us afterwards, and we will follow up and make sure that all of your questions are answered. But we'll probably consume most of the time with just getting through the materials today. So we'll just do that. The Catholic Foundation, I think most of you are aware because you're on this, so you're already aware of what we do with the community in terms of helping people with their giving for the kingdom of God, for the benefit of the church through us. So we are a financial intermediary that helps support all the Catholic parishes, schools, apostolates, etc. So we're so grateful to you to be our partner. Next month we'll be celebrating Thanksgiving, and you certainly are in our thoughts and prayers. So thank you for that. Before I pass it over to Joshua and Jay, let us begin with a prayer. In the name of the Father, and the Son, and the Holy Spirit, amen. Dear Lord, we are grateful for your many blessings upon us. May we be good stewards of all that you've entrusted to us. May we have this time to help us grow in your wisdom. And may we use that wisdom to be good stewards. May we use that wisdom to be, maximize the impact of our financial gifts. And may your Holy Spirit just continue to lead and guide us, and may we be attentive to the will of your will through your grace, and may we then be able to carry out that will in our lives. And we ask all this through Jesus Christ our Lord. Amen. So today's discussion is going to focus on three main areas. The first will be a basic, can you minimize that? Element of giving taxes, and then we'll move into the difference of giving with appreciated property. And then third, we're going to share how those who are or have family members who are over 70 years old can give from qualified plans tax efficiently. So two panelists, Joshua Gideon, my co-worker and fantastic team member, and then our mutual friend, Jay Schlipman, who has over 16 years of experience in many facets of federal and state income taxation, with particular emphasis on compliance and planning for high net worth individuals and closely held businesses. Prior to joining a boutique firm at R.G. Fowler, he spent most of his career at a large regional CPA firm in Denver. He also obtained his financial planning designation through the AICPA to further advise clients in financial planning beyond taxation. Jay is a certified public accountant, as I was at one time, and received bachelor's degrees from both Creighton University and Regis University. He spends most of his time outside of work with his beautiful wife and 5 children. At this point, Jay, I'll turn it over to you.
Great, thank you. Just wanted to start out with it's an incredible honor to be asked to present with the Catholic Foundation with Joshua here. I was thinking back to how long I've known Deacon Steve. So I think I've known Deacon Steve for over 20 years, if you can believe that. So anyway, it's an honor to be here. Obviously, there's a lot of different people on the webinar today. Some everyone's got a different situation that they're in. So we'll try to talk very broad strokes about some different strategies, some year-end giving. But overall, just wanted to be engaging to you, hopefully helpful, and as engaging as it can be with a tax accountant on the line. So Deacon Steve is known for loving his jokes. So my first joke of the day is, how can you tell an extroverted accountant? And the answer is the one who stares at your shoes when in a conversation as opposed to their own. So hopefully you'll have to put up with me. Hopefully I'll make it somewhat engaging. But great to be with you and spend time here today. So Josh, you can go to the next slide. So we cut out some of the very basics, and we jumped right into gifts of appreciated securities, because we're going to go through a lot of different aspects here today. And so keeping it somewhat simple, but kind of starting out with the basics of tax and tax giving. So gifts of appreciated securities is obviously a little bit more bang for your buck, if you will, more tax savings than just giving cash. So the tenets of just giving cash, obviously, is if you are itemizing your deductions, that you're just getting whatever tax rate you're in, tax rate that you're in, you would get the savings on that. So it's just a multiple of your cash giving. Whereas gifts of appreciated securities is going to be you kind of bypass, if you will, the gain that you would if you were to sell that, recognize the gain, you have to pay tax on that, and then you would give the gift of cash. So in this case, last year we were talking heavily about gifts of appreciated securities because the markets were doing so well last year. So that was a big conversation we were having. If you're anything like me in the portfolio I'm looking at, we don't have as much of that this year. The markets have not been performing as well in certain cases. And so on the inverse relationship to that is if you have securities that you want to give that are in a loss position, better to actually recognize the loss and then give cash. So that's a little bit reverse of where we were in previous years, but still the tenets here apply of gifts of appreciated securities, where this is a better gift at times than just giving cash, because you are bypassing any of the tax that you would pay on that. So another thing we can mention here is kind of what they would call a swap of your securities, in the sense of if you wanted to give away a security, let's just call it Apple stock. We have an Apple, Apple logo up there. I don't know why we always go to Apple stock. It just seems like that's, even in my conversations with clients, we always say Apple stock. I don't know. Maybe it's just because it starts with A. But anyway, if you liked your Apple stock in your portfolio, you could do a swap of that. So it's basically, the swap would be, if you take your Apple stock, you can give that to charity and then replace it and buy more shares of Apple stock to replace it in your portfolio. So that's kind of the idea of a swap in that particular situation. So we can go to the next slide. So again, this is pretty basic. A lot of this information, you could just go on Google and find out a lot of this information. So we tried to make it a few different things of aspects that we've dealt with dealing with clients or dealing with donors. But again, the tax rates for 2022, there wasn't a lot that got done in Congress this year. There was some bills passed for sure, but not a lot impacted kind of the day-to-day individuals. A lot of tax reform around C corporations, some international tax, but we're not seeing any major changes from 21 to 22 in terms of tax legislation and tax law changes. So with inflation, the brackets have gone up a little bit in terms of the taxable income. All of the rates are staying the same. And so we don't have a comparison year over year, but generally you can kind of say the tax rates remain the same. And then, just in terms of our tax situation, we do have an incremental tax. And so each bucket you jump into, so any dollar in this particular case, married filing joint, over $83,550, any dollar over that amount, it gets taxed at 22%. So it's not, once you go into that bucket, all of your tax is taxed at 22%. It is incremental and a graduated rate. So there is a lot of things we can do, and we'll talk about this in a second, but tax bracket management. So you'll hear that sometimes with CPAs or financial advisors, where you're trying to navigate that a little bit, and charitable contributions can fall into that in terms of tax bracket management. You also see that with Roth conversion, IRA Roth conversions, where you maybe are creating a little bit more income because you're in a particular tax bracket. So tax bracket management can come into play depending on where that is. So go back one slide, Josh. So here, I just wanted to point out that the long-term capital gain rates, just so you know, you actually can be in a situation where long-term capital gain rates are taxed at 0%. A lot of people don't know that, but below, so in this example of the married filing jointly of if you're in a tax bracket of less than $83,350, your capital gains rates and qualified dividends are taxed at 0%. And then it jumps up to 15%. That's most of the time where most people think of as capital gains rates are 15%. Some people would ask me, why do you have 18.8% in there? Well, at 250,000, that's where the quote unquote the net investment income tax is. A lot of people call it the Obamacare tax. That can come into play there. It's an additional 3.8%. So after 250,000, you have that net investment income come into play, and then you would jump up to the next phase is capital gains are taxed at a 20% rate. So just understanding that there is some differences there in capital gains and qualified dividends. So the next slide, I just wanted to throw out kind of an example to make this. I just thought I found this interesting. Maybe other people do or don't, but of how a person in the base case here, somebody actually can have $110,000 of income and actually pay 0 federal income tax on that. So in this case, if you had $40,000 of qualified dividends, tax exempt interest on muni bonds, that obviously that is tax free for federal purposes. Then you had long-term capital gains and Social Security income, and that was the extent of your income. Well, basically, I'm taking here $110,000, taking out the tax exempt interest. So you get to an adjusted gross income of your AGI on your return of $90,000, less just a typical standard deduction would be taxable income of $64,000. That you're in the tax bracket below that threshold. So actually all of your qualified dividends and long-term capital gains are actually taxed at 0%. So I just thought that was an interesting thing as I came across that. And then the next scenario here is the exact same situation. Go back one with the IRA distributions here, to take the exact same fact pattern and say that at the end of the year, you had $30,000 that had to be a required minimum distribution out of your IRA. So you're in retirement, you don't necessarily have that need for that cash, but it's required to come out. Well, distributions out of IRAs are taxable income, ordinary taxable income. And so in this particular case, just by adding that RMD in here, your tax liability would be, close to $4,700. So I just thought I'd point that out. So a good strategy in this particular case, if you were in the bucket on the right, is to say, well, would it make sense to do some sort of qualified charitable donation? It's called a QCD out of your IRA, to use some of that and reduce the amount of tax that you would be paying. So again, that's just one situation. I don't know if it fits anyone or everyone in the fact pattern here that was on the webinar. But just I found that interesting in terms of tax bracket management, of really looking at those things to say, if I get below this threshold, maybe I'm in a different bucket, right? Maybe I'm in a 0% for capital gains, or maybe I'm you manage your tax brackets and your rates. So something to keep in mind. Next slide. So as we get into this, just kind of wanted to explain, this is very basic. So basically standard deduction versus itemized deduction. So that changed just ever so slightly, just went up a couple $100 from 2021. So 2022 is just about the same. Big deal with that is, so with the TCJA, that was kind of during Trump's administration in 2018, where that changed the amount of the standard deduction increased significantly. Okay, so prior to 2018, there was about 45 million people who were using itemized deductions because the threshold for standard deduction was so low previous to that. And then once that changed, that significantly dropped the amount of people, because they capped the state real estate taxes and state income taxes to $10,000, and then you have your, mortgage interest, you've got charitable contributions, things like that. But if you're married filing joint and your total itemized deductions weren't over, in this case for 2022, 25,900, it really makes no sense to have all the receipts and the backup and get any benefit from that. So you just take the standard deduction. So significant reduction in people that were using itemized deductions, and that can come into play here with charitable contributions for sure. One item to note, last year in 2021, there was an above the line deduction of $300 per taxpayer. And so that was not extended for 2022. So not a huge number there, but even for people who were not using the standard deduction, you would still get this $300 per person. So married filing joint would be $600 that you could automatically get. That is no longer in play for 2022. And then I just thought I would bring up, I don't know if it impacts anyone, but kind of one of the House bills that was passed this last summer that really flew under the radar. And I just wanted to make sure people were aware of that, just because a lot of people aren't. It's a huge revenue raiser for the Colorado Department of Revenue. So they're going to cap itemized deductions for taxpayers exceeding $400,000 of AGI to $30,000 for a single person and $60,000 for a married filing joint person. So this is a big deal for somebody who, let's just say you were in a position that you sold a property, right? You had a rental property or something, and normally you aren't, you are below that $400,000 of AGI, but let's just say you had a particularly high gain or something like that. Let's say if you were to have over $400,000 of AGI, let's say you have $500,000 of adjusted gross income, and you gave away $100,000 to charity, plus you had your state income taxes, plus some mortgage interest. So let's say your itemized deductions are, let's just say for the sake of argument, $115,000. Well, Colorado is actually going to limit your itemized deductions and say you have to add back income to your federal taxable income. So could be a big deal for some of the clients we deal with, some high net worth taxpayers. You're losing some of those itemized deductions. So just wanted to throw that out there. I can take questions on that, but I just wanted to kind of put that out there. And then lastly, last year there were some special caveats that adjusted gross income with cash gifts were eligible to be at 100% of adjusted gross income, and that dropped down this year in 2022 back down to 60%. So that means if you have $1,000 of adjusted gross income, your charitable contributions that you can deduct are only up to 60% for cash gifts. There's some other limitations as well for non-cash gifts, for gifts to private foundations and things like that. We won't go into that today. So the next slide is about a strategy called bunching. This is a strategy where people can use this if you're using the standard deduction. So if you're like in this particular example, for 2022 without bunching, let's just look at the top and it says, so if you gave a $10,000 gift to charity, you're capped at your real estate and local state income taxes of $10,000, and you have some mortgage or investment interest of $3,000. Your total itemized deductions are $23,000, but the standard deduction is $25,000. So of course you're going to use the standard deduction because that's a greater benefit, right? So in this particular case, when you're giving to charity each year of $10,000, you're really getting no benefit in that, because you would get the standard deduction whether you were giving to charity or not. And so the strategy with bunching, and we'll talk about this a little bit as we get into donor advised funds and things like that, is that you can actually accumulate some of that cash. So over a 3-year period of time, you would have given $10,000 a year. So you give $30,000 in 1 year, you actually get a lot more benefit to that. So you can see down below with bunching that you're actually every 3 years, you're going to recognize those deductions on the charitable contribution. So in this particular case, again, it was assuming that you're at a married filing joint at a 32% tax bracket, but that's a potential tax savings of $10,900 of tax savings over that period of time. So just something to think about if you are in that you're always taking the standard deduction each year. Maybe it makes sense to do some bunching, maybe it doesn't. So next slide. Any questions so far? I'm going a little fast. I know there's a lot of information here, but hopefully it's one or two of these points, are useful to you. So,
Jay,
so this one is.
Jay, just to let you know, no, you're doing great on time, and we'll probably save some of the questions to the end.
Okay.
If we have time, or as kind of Deacon Steve said, it might be better like an individual follow-up. I imagine some of the questions are pretty unique, but
Sure.
We're doing great.
Sure. And I'm happy for anyone's on the webinar as well. Any question that you ask, I'll hopefully be able to answer, but we can always get back to you with those questions if we can't answer those immediately here. But this slide, again, I'm not an employee of the Catholic Foundation. I have no interest or benefit from doing this, but just kind of wanted to put some personal touch to this of somebody who's been doing this for 16, 17 years of dealing with a lot of different clients. Just some of my thoughts. And so this is just a slide just from me, and you can listen to this or not from a tax CPA. I love it. I found the definition of a tax accountant online. The definition of a tax accountant is someone who solves your problems that you didn't know you had in a way you don't understand. So I thought that was great, is that, us tax accountants, we get a bad rap, but we see a lot of these things, right? For charitable contributions, we're seeing those people because people that are doing itemized deductions, we're seeing those charitable receipts and seeing how people are doing giving. And so my first point here is just, while the year-end giving strategies are important, and that's why we're here today, is everyone's listening in to what can I do at the end of the year. I just feel like some of the most effective givers I've seen over the course of my career are people that execute a plan all year long, as opposed to get to the end of the year and say, oh no, I haven't given anything to charity, now what should I do? And that's where you find a lot of people where it's very low levels of giving because there's really nothing left. You get through the holidays and you get through Christmas and you say, there isn't much left to give. And so really, if that's a position you're in, that you want to be more effective in your giving, to really have that be a discernment process, to really pray about that, figure out, maybe the amount that you're giving, and then figure out a plan that you're using each month in order to kind of put that money away, maybe into a separate account, or we'll talk about donor advised funds. That's a great use to be able to have that separate account where you're just funding that donor advised fund each month to have more disciplined giving. And then decide how you're going to, execute on that plan. One of my kind of heroes or mentors or in life was, Archbishop Charles Chaput. And I remember when I was a long time ago when we were talking, and I asked the question of, well, how should you decide I know everyone says, give 10% or whatever, but how do you divvy that up? And it's something that's stuck with me forever. Is he kind of said, okay, that's what you should shoot for is 10% of your income. And then divide that out. And so if you have 10% and you figure here's a bucket here, out of that bucket to give, and this was just his advice, not necessarily mine, but I've stuck to it, is he said, okay, take that bucket that you've now put away 10% of your income and give 50% of that or half of that to your parish, to the things that they're doing, because they're serving many needs in the church. Give 50% of that, give 10% that fraction to the Archbishop's Catholic Appeal. So of course he would say that, right? But so that's what he recommended. And then the rest of that 40% of that bucket, he said, give to other charities. So I thought that was good advice. I've kind of held true to that. And so I just thought I'd share that. And then I'm no psychologist. I'm just a tax accountant. So, you know, take it for what it's worth. But in my own opinion and some of that is backed up by psychological studies, but kind of, I feel like there's 4 different categories of kind of that satisfaction or happiness in kind of use of money. And the first one in terms of giving is the person that is truly excited about the mission, you know, sees the dollars that impact that mission, are fully involved and fully engaged in that. I just feel like their level of satisfaction and happiness with giving is just top notch. And then kind of the next level would be, you know, giving solely for the benefit of the tax benefit, right? So somebody that's like, I want to save some money. I don't want to give it to Uncle Sam. What can I do? Okay, I can give it to charity. So I'd rather give it to them than give it to the government, you know, type of thing. I think the third level then would be somebody who's keeps all the money for themselves, that doesn't give anything at all. And then the next level would be someone who actually feels, you know, quote unquote, stolen from, somebody that's forced to give. So like a mandatory program, or, you know, people hate taxes. So they hate the kind of the mandatory thing. So again, just some musings here. And so if you find yourself, you know, maybe a person who's number 2 today, of somebody who's just trying to get the tax benefit, I'd encourage you to, you know, think about of trying to get more involved in where that money is going to, and being a part of the mission of that. Or if it's somebody who isn't giving now, then maybe it's moving up to that level of just doing it because it's a good thing to do. So just some musings on that. This next slide is donor advised funds. Donor advised funds are huge. I'm sure most of you have heard of them. It's taking kind of the world by storm. It's in the charitable giving world that private foundations used to be the thing that you would start. And the amount of private foundations are down significantly. I see clients who are high net worth, ultra high net worth, that are just using donor advised funds instead of public charities. You don't have things like your limitations on your gifts. You don't have the excise tax within the private foundation. But you still have all the tools that you use that people want to use in private foundations. You can have a teaching and legacy tool, so you can bring your kids along as a kind of a legacy or generational thing that you teach them about giving. Earnings within the donor advised fund are going to be tax free. So the way the donor advised fund works is you can go pre-fund that, essentially, if you will, you can go put in $100,000 into this fund, a donor advised fund, take the immediate deduction today, but yet those funds don't have to be distributed immediately to a particular charity. So those funds can continue to grow, and they can be distributed to those charities over time. So I see a lot of that in terms of somebody has a liquidity event, they sell a business, they sell a property, and they say, I have this extra money, but I don't know where it should go. I don't know if I want it to, I don't know where I want it to go. So putting it into a donor advised fund that they can decide on later is helpful as well. So we can go to the next slide. So again, my last slide here before I turn it over to Joshua is just things of did you know. So this again is my slide. This is not the Catholic Foundation slide. I put this in there because things that I've realized in the last short period of time is, so I said, did you know that the Catholic Foundation sets up and manages donor advised funds? As bad as that is, I actually didn't know that until probably in the last 2 years. I didn't know the Catholic Foundation had donor advised funds. Donor advised funds, you usually think of the big ones. So National Christian Foundations, great organization, has donor advised funds. Schwab Charitable, Fidelity, Vanguard, those are kind of the big ones that everyone thinks of donor advised funds. So there's going to be some differences with minimums and fees and things like that. But I mean, if I didn't know that, then maybe there's some people on the call that didn't know that either. donor advised funds that are not distributed to charity are grown inside the fund tax-free. So I just mentioned that on the last slide. The Catholic Foundation makes sure that the investments held are screened to be morally acceptable funds and investments. So that's a unique thing about them, as opposed to going to have a donor advised fund at a Schwab or Fidelity, is that the Catholic Foundation actually screens the funds that are then invested in those donor advised funds. So very helpful. And then just as a kind of a plug for these guys of Joshua specifically, I've gotten to know Joshua the last couple of years and have had some mutual clients that I've referred over to him, and I'm dealing with very sophisticated clients, and the level of knowledge and expertise that they have is top notch. So that's a plug for them. I'm not soliciting anything, but anyway. And then the last thing was just do your homework on donor advised funds. So that's the benefit of some of the bigger ones, Schwab and Fidelity, very, very low minimum. So you could go set up a donor advised fund for, $1,000, I believe. So very, very low minimums of what you can set up one, but there are fees associated with that. There's account minimums, and then there's types of assets that the donor advised fund can hold. So some might not hold privately held stock. There's a lot of different things that can go into donor advised funds. So just do your homework as you look in donor advised funds. So sorry I talked so long, and I'll turn that over to Joshua.
Jay, you're great. It has been such a fun time getting to know you and the family. And I'm so glad that Jay was able to help us out on a lot of the technical side. I'm going to take a few minutes of what we have left and just tell you some actual stories of gifts that we've worked with over the past few years. It's pretty fun. So I'm going to jump right into it, because at some point a donor might say, "I love giving, but I kind of might need more than a tax deduction," and that's okay, because some of the things that we've been able to do is help people in that situation. And so typically what happens is the donor gives something to charity, and the charity gives them back something, which is in the form of a tax deduction. Actually, the government does that. But there's certain type of vehicles that also allow you to receive kind of a lifetime income or a lump sum, like kind of a bargain sale. So I'm going to jump into a couple of those stories kind of right away. The first would be a gift annuity, especially with anxiety of the markets, where things are going to go, people looking for a more stable return, but still want to raise their hand and love charity. A charitable gift annuity can be a fantastic option. It's a fixed payments for life or a term, and you'll be receiving partially tax-free payments for the rest of your life, or again, that term, but you also get a deduction, and then you can use that deduction to offset obviously other income tax that you have that Jay shared. But it's essentially a fun way for somebody that, let's say you've already have charity in your estate plan, which is a beautiful gift, one of the most beautiful gifts. But on this side of heaven, there's no tangible benefit for you. A gift annuity kind of allows that person who says, I love the church, I love this charity, I wouldn't mind getting a little bit of benefit if it's possible. And so what happens, that donor gives that money to the foundation. I'll walk through a story right now. This was somebody that last year, she had received an inheritance from her mom, and she wanted to give back, and she was anxious about the markets. So she received $1 million, tithed 100% of 100,000 of it. And you'll see here that she was able to deduct roughly $33,000 on that gift, a gift that she was already going to make in her estate. She was able just to pull it forward. The charity received the assets, invested it, and is giving her an annuity for the rest of her life. And then whatever's left over, more or less, will go to charity. So it was a beautiful gift for her. So that's one option. The other thing that is that in that same lines is it doesn't just have to be cash or appreciated stock. If you have a business interest or a second home or land, I want to walk you through something called a life estate. But let's say this scenario that I'm going to pull up is a scenario of like a 55-year-old person that has some acreage. and they wanted to donate it. It was already going to go in their estate. They wanted to donate, but they kind of still loved it. They loved going back to it. So they deeded it, a remainder interest on the deed, and they get a deduction for that today. And then they get to use it for the rest of their life. And if they ever need to sell it or something, then the charity and the donor kind of work on an equitable solution to that. But it allowed them to get a tremendous deduction today that they could use for other good. So we're going to jump ahead again. I know we're going fast, but we'll be able to come back with some questions as well. But another similar kind of scenario that's a little bit kind of a step up from that gift annuity. With the gift annuity, it's a promise that the charity makes to you. With a charitable trust, it's a standalone trust that you can be trustee or have a lot of times an outside trustee, but you get to kind of manage how that property works. And so I'm going to walk you through a scenario, but this one's a beautiful story for me because this person had they had a couple rental properties over the course of their life. And I'm not sure if you own any rental properties, but at some point you'll probably say, I just am tired being a landlord. And that's kind of where they were at. But if they go to sell it, like Jay was talking on the capital gain side, they would have a tremendous capital gain hit. And so what we walked them through at that time was to say, what if we put that building, it was a small apartment complex with a few units with very low basis. What if we put that into a charitable trust? And so what they did is they put that charitable trust, or they put that building into that charitable trust. They had a $600,000 capital gain. If they would have sold it, they would have had to realize that right away. They put it into that trust. The trust sold it tax-free. And then now inside of that trust is not an apartment building. It's cash. It's funds that are, again, hopefully going to, grow. They're going to be invested. And then for the rest of their life, they're going to receive 5% out of that trust. Now, if that trust grows, that 5% is a bigger number. And then this one was unique because he also wanted to do it in such a way that he had like a lump sum out of it. So he didn't give it all to the trust. He put, roughly 80% of it into the trust, and 20% he just took out as an outright cash. So that's what this is. And then the rest of his life, he gets this. And here's the part I love. They loved taking vacations. They had a large family, loved taking annual vacations. So we set it up in such a way that they would receive lifetime income for both the husband and wife. And then I think it was for like 7 or 8 years that income would continue to the children so that to allow them to continue to go on these family vacations for their children. And you can tell I'm a little geeky. I just got goosebumps on it. It was a beautiful, beautiful gift. And one part of it was, I think that he was probably in that situation 2 or 3, maybe it's up to 1 that Jay was talking about. He just didn't like to pay taxes. He just did not want that much money going to taxes. And so that was kind of a beautiful, beautiful gift. So if you have an asset like that you're thinking about selling, let us show you an illustration first. And you might be surprised that you might have more available for family and charity than otherwise. Okay, the charitable rollover. This Jay mentioned this earlier. This is also growing quite a bit, like the donor advised fund. And essentially, we're going to walk through a couple scenarios on this, but the data of it is that it's up to $100,000 per person, and that it's out of an IRA, not a 401k or a different type of plan. We'll talk about something the way you can do it. And you have to talk to the custodian or send the IRA check, straight to the charity. It cannot go to a donor advised fund or to a split income gift like we talked about with that CGA or that charitable remainder trust. And it has to be received by the charity by the 31st. So that's a big qualifier. So that's the data. The reason people do this is because, similar to life insurance and probably some other assets that they bought earlier on or funded earlier on, the reasons that they put it in no longer exist for them keeping it. They don't need that income as much, and they don't like paying for the taxes. So when you give that gift to the charity, it's not deductible to you. The main thing is that you don't pay the taxes. So if you are taking the standard deduction, like Jay was mentioning, it is a fantastic way to make a great gift. I'm going to run through 4 scenarios of how people are making that great gift. So the first one is when you're 72, right now at least, you have to take a required minimum distribution, the RMD. And sometimes that's helpful to people. They need that income, and sometimes it's not. If it's not, this can be a great way for you to make either continue your current giving that you're doing or do an extra type of gift. However, in speaking to the extra type of gift, this number 2, you don't have to wait till you're age 72. I just met with a woman. It's a smaller IRA, maybe around 20,000, and she maybe gives a few $100s to $1,000 to her church every year. But there's a project that she's really excited about, and I was talking with her and listening to her what she was excited about, and we were talking about the estate. But then this kind of thing happened, and I just asked her, well, so do you need that IRA? Do you like that? And like, no, it's kind of a pain. I've got a larger 401k. This one's kind of a nuisance. I said, well, have you ever thought about just giving that directly to charity? And she's like, I can do that. And so now you should see her eyes lit up. She was able to make a 20x gift of what she would have thought she would have ever been possible on a nuisance to her. She just didn't want to deal with it. And now that, of course, Father's going to be completely excited. We got 3 minutes. A couple things. If you don't have an IRA, one of the things that we're talking to more people about is starting to roll those over into IRAs so that you can have this opportunity. And the other thing, if you are thinking about this IRA, if you give that to your children in their estate plan, it's a beautiful, any type of gift to charity or to children in your estate is beautiful. If you give that IRA to your children, as of right now, they'll have 10 years to wipe out that account. And then when they receive that income, it's at their top ordinary income level. So a good percentage potentially of what you had hoped will go to them will go actually to the government. So if you have anything going to charity, if you want information on that, contact us, because we can help you with how that works. And finally, if you have done a lot of these things already and you find yourself in a situation where you've got too many deductions, you can roll it forward 5 years. You got the year of the deduction and then 5 future years. I'm not an advisor in this. It's just something I've seen, and I think it seems like a neat idea, is to go ahead, if you have large IRAs that are traditional, to convert them and use that deduction to zero out that tax liability, because now you have a Roth that you can use whenever you want. So let's see how many. I think we're last. I guess I would lie. The one thing, you can also, life insurance policies. We have a beautiful situation where a woman gave it a $300,000 policy that she never thought was going to be able to, she'd ever make that type of gift ever. And she just didn't need it anymore. Her husband helped her out tremendously before that. All right, I'm going to take a breath because we rammed through that real quick, but I think that's all of it. And we're just at time. So let me step back. I do have an extra minute. That wasn't fair of me to pause on this. When you give this life insurance policy, how that works, now that I see I have an extra minute, you'll get a deduction for that policy. It's this is one of the few ones where it's the lesser value. So it's the lesser of your fair market value or your basis, what you owe on it. But still, it's this bucket over here that you might not need, and you might need a deduction, or you might just want to do something crazy awesome for God. I love some of the work that we've been able to see people that say, that whether they're giving 5% or 10%, we've now opened, some people are saying we're giving 20% of gross. And you're like, wow, how is that even possible? But they're just given permission. It's such a beautiful thing. So I'm going to end there. Finally, we don't have time for questions, but please email us any questions that you have. And Deacon Steve, because we're running late on time, I'm probably going to take your role and end it for us. Let me unmute you, Deacon Steve, and maybe you can say something. Are you there, Deacon Steve?
Thank you, Joshua, and thank you, Jay. Really appreciate it, and appreciate all of you that have been participating with us. As Joshua said, please reach out to either Jay or Joshua or myself or Lisa Kokura. Any of us would be happy to help you with any specific questions. And we're very grateful for your time this afternoon. And we look forward to continuing a conversation with you, whether it's soon or in the future. God bless you all.
Thanks, Deacon Steve. Bye, everyone.